All right. Good morning from a very cold Minnesota morning here. Welcome. Today is Thursday, January 22nd, 2026. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our different social media pages. If you are here with us live or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If you are new here, my name is Eric Hagan. I am a financial advisor and I am also president of Capital Consulting Group, or CCG. CCG consists of myself, of our chief investment officer, Tom Fox, who we will all hear from in just a minute or two, financial advisors Dan Oshman and Rana Grant, as well as Jeff Halverson, and our client support team, Karen Miller, Josh Denny, and Ann Colian. Together, our goal is to help individual investors make their next financial decision, and the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to kind of look over our shoulder, get a balanced analysis of what we see, and ultimately become a more informed investor. We do this in two ways. Number one, we can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. If you'd like to learn more about this after today's message, head on over to clearfinancialfuture.com. There's a nice short 2-minute video that goes into more detail. And second, we help our clients get invested right. Being invested right is distinct to every account that we manage. And SmartMix is our personalized portfolio solution for doing just that. Whether you have $25,000 or $25 million, SmartMix is our process for helping you get and stay invested right. And again, after today's message, if you'd like to learn more, you can do so at smartmixportfolios.com. Today, we're going to hear from Tom Fox. Tom is going to review the positives in the markets, the headwinds, and give us his outlook for the rest of 2026. Ultimately, this is your opportunity again to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy and what we're watching for. So I encourage you, if you have any questions during Tom's message, put them in the chat box wherever you're watching. I do see those. You're also invited to email me directly or text us at 952-540-0153. That is our office number, and you're invited to text us, and I will bring those questions to Tom at the end of today's message. Tom spends all of his time more behind the scenes, doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has over 35 years experience building investment strategies, and as you can see, he has an impressive long resume. As always, I am excited to have him here with us today. And again, at the end of today's message, I will open up the call for any Q&A. If you're watching with us live, I would love to field those questions, but also if you are watching in the recording, as I know many of you do, you are also invited to send us any questions that you have. We would love the opportunity to circle back with you. So with that, I will bring our theme for 2026 up onto the screen and bring Tom on stage here. Good morning, Tom.
Good morning, Eric. Good morning, everybody.
Tom, where are you in the world today? You're not in Minnesota, are you?
Not today. So, Eric, where I am, it's going to be a 90-degree difference between tomorrow's high and where I am right now. I'm in Florida and just left yesterday. Couldn't have been a better time.
Just incredible.
Yeah.
In contrast, I think that difference is going to be even wider tomorrow. We are looking and speculating whether or not the kids will have school. It looks like it's going to be close to 20 below actual temperature at the bus tomorrow morning. So
Okay.
enjoy the sun down there.
Well, that means it's 100-degree difference.
You and your numbers. Love it. All right. So things have changed, Tom.
Yes. We're seeing corporations and employees using AI more and more. and it's actually impacting the productivity, profit margins, and we're only at the beginning of this AI revolution, and we'll talk more about that. But I'm very excited because remember last year or last 2 years, the times are a changing. Well, things have changed. We have a accommodative administration in the White House that is all pro-growth, pro-stocks. So that's all helping in what's going on today. You got the big, beautiful bill. We've got many other things going on, less restrictions, pro-growth. Everything's pro-growth for the next 3 years. So here's our outlook. You ready? Get drum roll. So some of these are the same, and I always like to start off, Eric, as you know, with the worries, because the market always is facing worries, and probably the top one is the valuation risk. Right now, we're at a forward PE ratio of about 22. Especially they're higher in the mega cap tech. So everything's priced for perfection. So if there's any hiccups, it could bring down the market. And of course, S&P 500 has its biggest weight now is 40% is the big top 10 techs. So if something goes down in one of those, the whole market could come down. But so far, so good. Then we have our policy and political risk. We just saw this. Now, I put this out a couple days ago, but recent Greenland tariffs, the market got hit. I did send an email to Eric. I said, buy the dip. It's turned out because yesterday and today have been up. And because most of these threats and so on are the art of the deal. So it didn't hurt the market very long. So, but we got midterms coming up. We've got regulatory shifts, trade, you never know, tax and all that. But it's all something to worry about. Then we have what happens if the Fed delays the rate cut, because there is an expectation for 2 cuts in 26. Well, they could decide not to raise it. Sticky service inflation, keep policy tighter for longer than markets expect. The other thing that could happen is the economy does well, and they don't think it's necessary to lower the rates. Now, their focus has shifted from inflation, because we're going to look at some numbers. Inflation has been coming down, and it's shifted to employment. So their eyes are more focused on employment, what's happening in the labor market. So that could go either way. The last numbers we got were sort of mixed, and they are pointing that it's stabilized, but it has been weakening for a while. And then, of course, execution risk. This is a big one. Is all this money being poured in A going to end up somewhere that's going to help companies? And we are already seeing it is. Payoff timelines may be different, but there's a lot of money going in to data centers and things like that. So the question is, when are companies, or even the companies building the hardware, going to be able to benefit from that? Well, the hardware people are benefiting now, but what about the rest of the companies, software companies, things like that? And even right now, there's a fear that software companies will be replaced by AI. So the whole segment of software has been going down, and actually a lot of companies in there have become inexpensive. Now there's argument on both sides, but the whole AI monetization is something we got to watch. We think it's going to be absolutely positive. We'll talk more about that later. Then, of course, you got geopolitical event. If something happens, Iran was heating up just a little while ago. Was the U.S. going to bomb Iran again? Then if that happens, there's an energy shock, could disrupt supply chains. Of course, right now, energy is so inexpensive. If there was a shock, it could raise prices, which has an impact on the economy and everything we do, because it takes energy to move everything. So energy is a big part of the cost of our economy. So we do, hopefully that does not happen. Then we got index concentration. We've talked about this narrow group. 10 stocks dominate the S&P 500, 40% of it, of the weighting, and they're all in the tech area. So that could, again, be a big hiccup if something goes wrong. Then we got of course, the deficits, the fiscal overhang. Well, it could have higher taxes to fund all that deficit. And we can increase the bond market volatility. So that is a longer term fear, but it's still out there, and we'll see what happens. And then, of course, the Supreme Court is expected to rule against Trump in the tariff ability for him to just throw on tariffs like he was just threatening over Greenland. So they could take that away. I don't think anybody knows for sure what the outcome will be, but it's supposed to be not a big outcome. That's what I keep hearing, is that there's other ways he can put tariffs on countries. So he would just go down a different road, or there could be that the Supreme Court says you can do this, but you can't do this. So it could be a mix. But the overall expectation is it will have a very minor impact on the stock market, whichever way it goes. And of course, we're at 3 years of positive returns, 2 years over 20, third year almost 20%. We've had great moves in the market going up. So chasing winners, has that become costly? Could the market now go down because we've had such a great 3 years? And of course, that is always something to think about. Is it over? Is the 3 years the end of it? And so far it's up, but we'll see what happens here as we move forward. So why, Eric, should we own stocks? Because we're in stocks. Well, here's one. Productivity and profit margins are expanding. And these are AI related and automation technology. Right now, companies are growing fast, and their productivity and their margins are all expanding. And that's what we see in the earnings resilience. We're looking at double-digit returns, growth rates in earnings. In fact, some are even raising their earnings outlook. Well, ultimately, stocks prices are dependent upon earnings. So this is a big thing. And there's been such resilience. Many people thought, well, the tariffs were going to impact earnings. They didn't really do that. There was a lot of talk a year ago about things were going to go down because of after April's tariff day, when they put all the tariffs on and the stock market fell dramatically. We came in somewhere in the middle of March, not right at the bottom, but pretty close. And then we went back into more growth-oriented things. So it turned out really well. So inflation is falling. Fed is more likely to continue lowering rates. So I don't think inflation is going to be a problem. And it depends which way the labor market goes. So I still am pretty bullish on the Fed lowering rates 1 or 2 times this year. So we'll see what happens there. CapEx super cycle continues. There's still money. There seems to be no end to it. AI, power, infrastructures, reshoring has multiple year growth. The companies that are doing this are not talking about a 1-year wonder. They're talking about years of CapEx spending. CapEx is corporations investing in the future. So this isn't over. We may be in the 3rd inning of CapEx super cycle. Then the one big beautiful bill, benefit lower effective tax rates. Everybody likes that. Accelerated depreciation for investments. It's going to boost cash flow. It's going to probably support higher valuations, even though we're at 22. So I think this year, as all this kicks in, because remember, this wasn't there last year. It's here this year. And I just think the benefits are going to be really fantastic for corporations and, of course, the stock market. And we have very strong corporate balance sheets. After the pandemic, many of the companies lowered their costs. They really got efficient because of the pandemic. Well, when they came out of the pandemic, their top line began to grow as it is today. And of course, they learned how to lower their expenses. And so that is a really good thing for their balance sheets. Many of them have a lot of cash and looking good. All right. Operating leverage expands. So stabilizing costs, when you have many of the costs have already been set and stabilized. So it could, and now we get revenue growth, and if they keep their costs down and it goes to the top line, then you're going to have profitability. And I think this is what's happening even right now. Another positive is the buybacks and dividends continue to grow. We're seeing lots of buybacks and we're seeing dividend growth. All this is pointing to that the companies are financially healthy. They're able to buy their stock or increase the dividends. All that points to we're not in a bad time. This is a good time. And we're seeing that in their behavior of increasing both those. And then, of course, the U.S. is the favored destination still. We're the strongest nation in the world. We have a great system here. And so there's a lots of foreign money going to be invested in the U.S., all positive for U.S. stocks. So we remain bullish, Eric, for the year. But as I said, we'll see this later in my summary, expect high volatility. We had a little picture of that. 3 trading days ago, the market went down. And then it went the opposite way this last 2 days. So there's going to be a lot of volatility, and because there's a lot of uncertainty in the world right now, and it will be probably temporary. And I think there will be high volatility not only potentially to the downside, but also to the upside. We saw that last year where you had huge moves. In fact, in April, if you remember, Eric, the stock market went up 9.6% in 1 day.
1 day.
1 day.
That was incredible.
If you missed out, you missed out. So that I expect lots of volatility this year. And that's why as investors, we need to remain patient. Hold the course. Now, the Goldman Sachs put this out. I thought it was interesting. It shows 87% probability of a positive return in the stocks this year, 65% probability of return over 10% or greater, and 32% of 20% or greater. But it's the far left one that caught my attention, decline in the stock market. Goldman Sachs gives it a 4% probability. And the reason is the amazing profit growth and the strong economy. We'll look at some economic numbers, but later in the presentation. But based on their analysis that they did recently, this is a 96% probability of positive returns. So this is very high. Of course, past performance doesn't always make future performance. But it's something that, Goldman Sachs has a great research firm. Anyway, what this tells them, they're where we are. We're bullish. They're bullish, obviously, too. Here's another positive. When you get other companies beginning to perform well and their earnings are growing and their profitability is growing across the board, not just the tech companies, the biggest Mag 7, for example, you can see how back in 23, where the Mag 7s had huge profit growth, yet the rest of them companies were negative. And then it kind of switched around. But look at 25. We've already seen it narrowing. And 26 is that the profit growth, change in earnings is going to come very close to the other 493 companies out there. So typically, when you're not relying on a small group of stocks, but it broadens out, positive things broaden out to the others, that means the stock market bull market is not ending, but probably has room to even go higher. Here's some expectation. If you look, it's showing a number of things. It's showing the S&P 500 expected earnings growth to be double digit. And it's expected even the 27 to be a 14%. 14% this year we're in now. But if you look at the bottom, net margins are growing, revenue is growing, everything is going up, expected in this year and next. That's a pretty big revenue growth driver. And so you see the corporate America is benefiting from all the technology changes we're experiencing right now. So we just started a new earnings seasons. This is only 7% of the S&P 500. However, it's 79, almost 80% are beating by 5.7. We'll see where that shakes out. We have a big earnings over the next 3 weeks. A lot of companies will be reporting, and we'll see. But so far, it's so good for this quarter. Remember, we had the government shutdown in the fourth quarter, so that will impact some companies, but temporarily. And then they'll pick up again this quarter, which will be released in the second quarter. But so far, it's so good. Here's profit margins. And these are the shaded area are the estimates. But you can see profit margins for companies are rising and expected to rise even into 27. This is amazing. And a lot of this is because of the AI, but also, if you think about it, many analysts were forecasting that tariffs were going to be a meaningful drag on profit margins. It hasn't come to pass. They're going up, and the estimates are they're going to even go higher. A lot of that has to do with AI, but the impact of tariffs have not hurt companies. Here's an interesting chart. It shows it shows the corporate profits, which is the blue line. It's going straight up, and then U.S. payrolls. And you can see there's a kind of a flattening out of U.S. payrolls while profits keep going up. So what this shows is that more productivity is happening with less people. And you can see we're sort of stagnant. There's not people getting jobs. There's not people being released from jobs. But corporations are at the beginning of how to use AI to benefit their company. And so we're in the I think we're in the first inning, but it's already starting to show up in the profitability and the need not to keep growing labor payrolls, because that difference is amazing. And this is what's going on in companies. Here's another positive, and that is it's a good sign for stocks that M&A, merger acquisition deals, are expected to be even higher as we go into 26. They had a great year in 25, and it's the expectation is that for it to even go up this year. So we'll see where the numbers come out, but this is a sign that the economy is doing well when you have this kind of merger and acquisition volume that's going on. So this is another pointing to another bullish sign for the stock market. Now, this is an interesting one, and this has a great track record. The first 5 days, it's called the 5-day rule of the year, is the stock market positive or negative, first 5 trading days. And if it's positive, and it was up 1.11%, that tends to bode well for the rest of the year. So if you look at all the years that this goes back to, 1950 to 25, it's a long time. So all the years average 12%. That's the annualized return. However, the years that the stock market did well in the first 5 days, the average return was 16%. And if the first 5 days was negative, the average return was 3%. Then if you look at the consistency, when the market's positive the first 5 days, it's 84% probability that it'll be positive the rest of the year. And of course, if it's negative, it's almost cut to half. So this points, and we did have a 1.11 return in the first 5 days this year. That tends to bode well for the stock market for the rest of the year. Again, we're expecting high volatility. Is this NFL, the AFC versus the NFC, whoever wins, determines the outcome of the stock market? I think that's got a good record too. But I think there's some reasons behind this, that where people are restructuring their portfolios for what they think is going to happen this year. And obviously, it was a positive outcome at the beginning of this year. So that's the 5-day rule. It's got a good track record. So we'll have to see. Here's another positive. If you look on the far right, you're going to see that the 26 and so on, that the GDP growth is expected to be resilient. We're not looking at any downside. We're not looking at any thing going negative or coming down in a big way. I have my sense is that the GDP growth rate will surprise people to the upside. I think the economy is going to grow faster than what's even listed here in this chart. So that's that's a good thing, because obviously if the economy is doing well, stocks typically do well, and corporations do well. So I don't see any recession right now in the future. There will be one down the road, but I don't see it right now. I'm not expecting any kind of recession in 26. I'm expecting growth, and I think it's going to surprise to the upside. Here's another interesting Venezuela developments. And if the oil companies in the U.S. get involved, which it looks like they will, it looks like Venezuela is starting to cooperate with the U.S. If that happens, there's going to be more supply. And if you look at the blue line, Eric, that has been going up since 22. And that's the global oil supply has been rising. And if you look at the cost, what the crude oil price, you can see that's been going down. They're inverse to each other. Well, if Venezuela starts kicking up, because their wells have not been functioning well, there were very little oil coming out of Venezuela compared to their capacity. Well, if that turns around, because they have the largest proven oil fields in the world. If that happens, we're going to have a greater supply, which pushes down the price of oil, which of course lowers inflation, because everything's related to energy to move things around. Everything goes back to the energy level. This is very positive for the outlook in the economy. You can take a look here. You can see it in a different way. You can see, go next one. Yeah. You can see where it peaked out, 22, and then it has come down ever since. But a big thing is, if you see that yellow dotted line, yellowish dotted line, that's the price of gasoline. That's like a tax credit to consumers, because they're paying less to drive their car. Everybody's driving a car somewhere. So that's sort of a tax benefit to them in a way. So this is very positive for the consumer. I think it's going to even come down further than it is already. And this is all positive for the economy. Here's a look at the inflation. You can see it's been coming down, core inflation, headline inflation. It keeps, it's on a measured path. It's heading downward. And we'll look at the next chart. It shows you that CPI inflation is falling like a rock. It's It's already coming down. It beat the estimates in September. Then, of course, we had the data delay. So it's the October, November because of the government shutdown. It bested that. It was better. And in this last December, this new number we just looked at, it was better. So we're seeing inflation coming in the last 3 months lower than expectation. And we think that's going to continue, especially with energy costs as low as they are. I think it's just going to keep heading that way. And rents are coming down. There's many things that are starting to turn around. Now I put this in here. It's already been resolved, I think. Eric, did I not send this before?
Yeah.
2 days ago?
Yeah. 2 days ago in the morning. Yep.
Yeah, that's right. So there was no announcement in Trump's speech then, but what I know is that any of these tariff threats are short-lived to the stock market. This chart shows the yellow line, which is the S&P 500, and then of course the other one is trade policy uncertainty, mostly around tariffs. And you can see that the market rebounded after that high uncertainty, and it didn't last very long. And so when he started talking about Greenland having a 10% on countries that would be against the U.S. having Greenland, I just thought about it, and I said, this is going to be short-lived. It was much shorter than I thought. It was what, 1 day, 2 days?
Yeah.
And then it's already turned around. So the tariff fears are, if you see that and the market goes down, that's buy the dip. All right, reasons to worry. There are a few reasons. One is in jobs. This is a survey, probability of finding a job for people that are looking for a job. It's at an all-time low since 2014. So it's getting more and more difficult to find a job. And so you don't really want to lose your job because the odds are not where they were back at the pandemic turnaround, post-pandemic. This is a very different job market we're in. Again, some of the signals were mixed, seemed to stabilize a little bit, but this is something the Fed's watching. But it could end up, if it keeps weakening, that they're going to lower rates to protect it. So that's a positive for stocks. So I think we're in good shape here. Housing starts. This is a big problem. Right now, the administration is trying to fix this. But you see the darker blue line, that's housing starts versus housing completions. They're both coming down. But look at where housing starts have fallen. And the momentum is downward because people aren't buying new houses. There's a need for them, but many people cannot afford to buy a house right now. So this is the housing market is sort of in a depression, and we'll see where it ends up. But this is another problem because it's a big part of the economy. And understanding real drivers of your mortgage rate, I think it's at 6.1 right now, but it's made up, that number is multi-factored on what influences the mortgage rates. A big one, the 2.7 on the far right, that's what it right now is inflation. So that inflation definitely needs to come down. You got real funds rate, that may go lower. But you can see that the mortgage spread right now is very high because of the potential risks. So I think that if they lower rates, it's only going to have a small impact on the actual 30-year mortgage rate. So if you're looking for the old days where you had 2.8 or 2.6, I don't think it's going to happen. We'd have to go through a economic recession, a bear market for that to happen. I don't see that unless the labor market really weakens and they have to lower it. some of this, but it's not going to have a direct impact on 30-year fix. It's going to be a slow, maybe it goes to 5.5 at the end of the day, but it's not going to drop to 2.8. Metals, everybody wants gold and silver.
I'm getting more and more calls on this one, Tom.
Yes. So I think at the end of the year, last year, I was at I think it was this presentation, but I said I wouldn't sell your gold or precious metals, but I wouldn't buy it either. And I am still there, Eric. Been wrong because the market moved back up even more. You can see gold, silver is up. The top line is silver, and then you have gold, and you have copper. And if you look at the S&P 500, is the yellow line down there. So it's outperformed. Coulda, woulda, shoulda. I wish I would have had an IAU or one of the gold ETFs into the portfolio, but I've never been a big metal fan. And but I was wrong. So what do you do today? I would be very cautious to put money into it right now, where the prices are. Could go higher, and the next chart shows us one of the reasons why.
Is this the chart you wanted?
No. Well, you can see, excuse me, yes, it is. Foreign reserve holdings. You can see we got US, we got dollars, we got euros, US dollars, and then we have gold and treasuries. Where's the money going for foreign reserves? Look at that move upward where the arrow is. That's gold. So gold has taken off as a percentage, and actually has surpassed the percentage of foreign reserves that are holding treasuries. So this is a huge move. You can see how big it is, but this is one of the big reasons for foreign reserves impacting the gold price, because you can see how much they're buying. This is a big deal. So, why do they want to do that? Well, they don't trust fiat currency. Obviously, they don't probably trust Bitcoin with all its volatility. And so they think the geopolitical world is at risk. So a safe haven would be gold. And that's why they're in gold, increasing gold. So this hasn't changed. Our outlook for 26, shifting towards a more favorable environment, the big, beautiful bill. Particular risk as companies, economies benefit from AI. We think interest rate cuts by the Fed, global disinflation, and growth. All this is pointing to a positive 26. We haven't moved from that. That was in our outlook at the beginning. And all those are still driving, we think, the stock market higher. So this hasn't changed either. We got extreme volatility. We've already had a little bit of that. I expect a lot more throughout the year, especially in the AI stocks. But the economy stays resilient. They keep spending, no recession. We talked about that. Deflation. CPI retreats to target 2%. I think that happens this year. Fed keeps cutting rates because they can. And due to labor weakness. I think the big key there, of course, is the labor markets, how well, if they keep declining and weakening, that could be a reason for the Fed to even cut more. Bonds continue a rally because I think as rates slowly come down, they'll have a positive return. I don't think it's going to be as good of a return as last year. I think it's going to be positive though. So we're bullish on stocks. Pullbacks and weakness, like just the other day, as a buying opportunity. We got this policy support, accommodative Fed, AI-driven productivity gains. We're seeing that. I believe ASI stocks will start to lead again. Other stocks, the other 493 have actually outperformed. so far in 26, but I expect that to go back to AI stocks, especially after earnings are all out. I think there'll be another rally in AI stocks. So we always like to list. Well, here's the stocks end year positive. We're expecting intra-year correction, and correction is 10% to 19.99%. I expect that to happen. We've looked at this before, Eric. The average pullback within any year is 14+%. So we're right in there. I expect it to happen this year. Something will probably kick it off, but I expect a 10 to 15%. That's our forecast return by year end. And of course, we got our whole list of wild card events, and but I remain bullish. I think pullbacks will be a great time to put more cash to work.
Very good. Thank you, Tom, as always. Really appreciate the balanced approach that you take. Give us the good, the bad, and help everybody make sense of it. So thank you very much for that.
You're welcome.
I would love to field any questions for Tom. I've got my email open. I've got our texting open. If you have a question, you can put it in the comments section wherever you're watching. So if you're on Facebook, you can just comment below this video. I will see that. I do see a good number of you out there. So thanks for joining us today. If you have any questions, now's your opportunity. Email, text, drop in the comments, whatever you're comfortable with. While you're typing your many questions, everybody, I will, just a reminder, I will have the recording to this message will be on the website here this afternoon, as well as a button if you'd like to ask a question more privately. You can just fill out the form. I will get that. I'll get that to Tom, and we would love the opportunity to circle back with you. I'll also have a summary, so a nice brief 2-page summary of Tom's presentation, the positives, the negatives, and kind of his outlook moving forward. Mark your calendar. Our next monthly presentation with Tom will be Thursday, February 19th. That will be online again, just like we are doing today. Probably planning ahead for Tom, because knowing that difference in temperature, it's going to be really hard to get him back here to Minnesota. So
100 degrees.
Make sure Tom's taken care of there. So Thursday, February 19th will be our next message. If you're not already, thank you to those who do. I start my week off every Monday morning, 9 a.m. with a brief update on what's happening in the markets, 3 to 5 minutes summarizing what's going on the previous week, as well as some nuggets that we're looking for. Just like today on the website, all the different social media pages. And then later on in the day, 2 p.m. Central, I send out an email pointing back to that recording, as well as some additional colors. So if you're not getting that, you can subscribe at our website, of course, www.investwithccg.com. All right, Tom, one more look here. I do not see any questions from our group here today. So any closing thoughts, and I can wrap us up and get you back to outside to some warmer weather or something.
Yes, I'm looking at a palm tree right now.
I'm just rubbing it in.
Yeah. The thing we've been talking about, we're bullish on stocks, but it's not going to be a straight road. It's going to be up and down. So there'll be opportunities maybe to put some money to work. But we expect it to be bumpy. And then by the year end, again, we're looking at a 10 to 15% positive return. But it's, again, not going to be in a straight line. So we need, as investors, patience to go through this year. I do think that the economy is going to surprise to the upside because of the big, beautiful bill and AI and many other things. So I think and the energy prices are low. They're getting lower. All this points to me that we have maybe a major upside in the economy and over the next 3 years. So we'll see what happens. But again, we're positive for this year.
Excellent. So would it be fair to say things have changed?
Yes.
And change can be hard, but change can also be good.
I think the changes are going to be good.
Wonderful. Awesome. Well, thank you again, Tom. And thank you, everybody, for joining us here today, both the those of you who joined us live, as well as those who are watching in the recording. We appreciate you taking the time. That concludes this month's capital markets update and outlook call for January 2026. Hope you all in Minnesota stay warm, and for everybody else, wish you the best. We'll see everybody soon. Thanks, everybody.